what exactly is an iron condor? Don't let the name intimidate you, it's actually very simple. The first part of an iron condor consists of selling to open an out of the money put and simultaneously selling to open an out of the money call. We would do this in hopes that between now and expiration, the stock will stay in between the strikes and the options we sold will go to zero. If this is the case, we will keep the entire price we sold these options for. But since short naked options can have a lot of risk and can require a lot of capital, we are also going to buy a further out of the money put and call for protection. These four option trades are collectively called an iron condor. But we're selling two options and buying two options. So how does this work? Well, let me show you. Stock XYZ is trading at $75 per share. Let's sell the 85 call for $2, and we're also going to sell the 65 put for $2. And our idea is that the stock will stay in between these strikes, and the options we sold will expire worthless. But again, since naked options theoretically have unlimited risk, we are going to buy some protection. So we're also going to buy the 90 call for $1 and the 60 put for $1. And I know that keeping track with all of these individual option trades seems like a lot to keep up with, but we can actually trade an iron condor with one order and view it as one trade. And I'm going to show you how to do that in the end of the video, but for now, just stick with me. Let's say we initiated this trade with 30 days to expiration. And as time passes and we near expiration, let's say the stock doesn't move much and just kind of bounces around and trades sideways. So as we near expiration, these options remain out of the money and the price of each option gradually goes to zero. If all of these options are worthless, what does that mean for our trade? Well, we make $200 on the 85 call and also on the 65 put because we are short those options and they are now at zero. So we collected a credit, and since they are of no value, we get to keep that credit. Okay, but we also lost some money on the options we bought as protection. We lost $100 on the 90 strike call and also on the 60 strike put because we bought these options and they now have no value. Adding all of these numbers up totals to a net profit of $200 because we made $400 on the short options and lost $200 on the long options. So by trading an iron condor, we are simply betting that the stock will stay within a certain range, and we treat it as one trade. We lost money on the long call and put, but that's exactly what we want to happen because we simply bought these options as protection. It's kind of like we pay for car insurance, but we don't actually want to crash our car. So now that you know how we make money on the trade, let me show you how we can lose money and also how much we can lose. Let's say the stock goes crazy, and although it was completely unexpected, it goes well outside of our range we wanted it to stay in and ends up at $96 per share. Well, we already know that both the long put and the short put are out of the money and are worthless. So we made $200 on the short put and lost $100 on the long put. So this totals to a net profit of $100 on the puts. But what about the calls? The 85 call is 11 points in the money, so it's worth 11. And the 90 call is 6 points in the money, so it's worth 6. We are short the 85 call at 2, and it's at 11, so this means we lost 9 points or $900 on that leg of the trade. So that sucks, but fortunately we bought the 90 call for protection. We paid $1 for the 90 call, and it's now trading at 6. So we made $500 on that leg of the trade. This $500 and the $100 we made on the put side cancels out much of the $900 we lost on the short call. Adding up all of these numbers totals to a net loss of $300 on the entire trade. Now, this is the cool part. We lost $300 on the entire trade, but that's the maximum amount we can lose on this trade, no matter where the stock is. It doesn't matter if the stock goes to 104, 25, 0, infinity, whatever the case may be, we can't lose more than $300 on this trade. And the way we end up with this max loss is if the stock is outside of our long option strikes at the expiration date.